Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we're going to do another update on the mergers and acquisitions within the cannabis space. We're going to be asking the question, did this virus kill the cannabis industry's merger and acquisition activity? So capital raise activity recorded its strongest showing for the year with 17 transactions, raising a total of $133 million versus 19 transactions totaling $210 million. So of the 17 capital raises, 12 or 71% were closed by public companies. This is lower than the 80% of capital raises that public companies have accounted for over the past 6 months, but still indicative that investors are choosing to invest in the cannabis sector through public companies that offer great liquidity. Of the 12 companies with capital raises, all were Canadian exchange listed. So also bucking the trends after reporting for the last 6 months is the fact that equity-based raises accounted for 13 of the 17 transactions, or 76%. That's higher than the 71% of equity-based capital raises that we've tracked over the last 6 months. This is likely indicative of the fact that a number of public cannabis stocks bounced off their lows after initial impact on stock prices, so leading more public companies to accept equity deals. 9 of the public company raises this period were equity-based structures. So we were seeing a lot of debt raises before. And so obviously with incredibly low valuations, people are picking up a lot of shares for very, very low stock prices. Of the 4 debt-based transactions, 3 were convertible note structures, which remain dominant form of debt financing in the cannabis industry. That just kind of shows that there's a significant amount of risk aversion by asking for a convertible note. While we saw equity investment bucking that trend from previously seen debt rounds, we're also seeing some similarities with cultivation and retail taking the dominant amount of deals being completed. So we're seeing that cultivation and retail are accounting for more than 60% of all of the capital raises. We saw cultivation and retail have 7 capital raises. Infused products and extracts have 4 cap raises. Biotech pharma saw 3, software and media saw 2, and investment M&As saw 1. So mergers and acquisitions may have dried up, but it's not dead. Taking a look at 2019, there were over 290 mergers and acquisition transactions in the cannabis industry. So over 3 months into 2020, there's been just 20 so far, leading many investors to question whether or not the novel coronavirus has killed the cannabis industry's M&A streak. So due to this virus's impact on the global economy since the beginning of 2020, the S&P index is down nearly 20%. Worse than that is the ETFMG Alternative Harvest ETF is an exchange-traded fund. It's down nearly 40% year to date. So with so many cannabis companies' stock prices crashing down to near 52-week lows, their cost of capital is greatly increased, making both capital raising and stock-based transactions far less feasible. So in 2019, for example, you saw multi-state operator license holder Green Growth Brands announce a handful of major acquisitions. Fast forward to 2020, and Green Growth Brands has received a notice of default related to a $5 million U.S. note, and 6 of the company's CBD-infused subsidiaries are now under receivership order. So another active acquirer in 2019, another multi-state operator, Ianthus Capital Holdings, they haven't done much better. So that company announced it's going to make interest payments. It's not going to make interest payments on a 13% senior secured debenture and a 13% unsecured convertible debenture. So they defaulted on a total of $4.4 million of interest obligations and $157 million in debt. And their stock was put on hold for a few hours while regulators questioned them about their ability to remain in business. So according to Viridian Capital Advisors, the week ended March 20th, they saw a 66.6% decrease in M&A activities. So there's a decrease in overall market caps as a lot of these companies' stock prices start decreasing significantly, like Canopy Growths, for example. So they're going to start pulling back, not because it's more efficient, but because it saves money. So while they say that they're leaving Latin America for more efficiencies, that's not the case. It's to save money. So they're really pulling back, as this Marijuana Business Daily article shows. Canopy Growth is exiting their cannabis cultivation on 3 continents in a major international pullback. So this pullback comes after the Canadian processor or producer racked up net losses exceeding 6 billion Canadian dollars in 2019. As part of the downsizing, Canopy is closing another cultivation facility in Canada. I think that they're going to be transitioning from indoor to outdoor. Looking at Colombia, they're ceasing the cultivation in Colombia for some reason. I think that's crazy. They have good terroir, they have low labor. They should just silo it or make a concentrate out of it and continue to do that. They are, however, moving into Africa. So they've entered into an agreement to exit its operations in South Africa. So they are exiting everywhere. That makes more sense. They're also exiting the US. That is a terrible indicator for me. So the cut includes ceasing its farming operations in Springfield, New York, due to an abundance of hemp produced in 2019 growth season. Well, you can still use that hemp for CBG, CBN, THC, well, not THCV, but other rare cannabinoids from hemp you can use. So it makes absolutely no sense to stop. It just means that they don't have enough money. Their burn rate is too high. So within 18 months, they would be out of business if people aren't buying. And that's the problem, is people are really cutting back right now. So even as Canopy announces it's leaving Latin America, it just announced a regional supply agreement with Clever Leaves out of Colombia. So it looks like they're just getting out, they're outsourcing everything through Clever Leaves, and then possibly having an exclusive regional supply agreement with Clever Leaves out of Colombia. So COVID is causing serious jitters among large cannabis companies, with a growing list of multi-state marijuana operators scaling back by laying off workers and shuttering operations in a bid to slash costs. So the widespread cutbacks this week is by Acreage Holdings, MedMen, Forefront Ventures. They all called into question the overall health of the cannabis industry as the U.S. economy appears headed into a sharp downturn. They believe that social distancing measures to contain the virus will continue reductions in economic activity and put significant pressures on consumer spending. For these companies that do stay in business, some will file bankruptcy, some will just go out of business depending on where they're at. Some will be bought out, some will be more than happy to merge. Some will have capitulation where they don't really have a choice, and some will have hostile takeovers. What we're seeing right now is people playing nice together. So there's a Chinese pharma company that had a private placement with Abacana. So we're seeing the Chinese getting involved. So I would imagine that's going to escalate significantly with FOMO, just as other Chinese business individuals and companies hear about this as an opportunity. They're going to race into it. So I would imagine that's going to take place with some of the vulture funds, if you will. The distressed assets are going to be making its way around in the older markets of Washington and Colorado, even in Oregon, and certain companies in California that didn't open properly will already be looking for an exit. So Tasly Holdings is a Chinese pharmaceutical and healthcare company. They have a $22 billion market cap listed on the Shanghai Stock Exchange. So it looks like they announced on Tuesday of a private placement deal with an Ontario-based cannabis research and producer, Avacana. So as some Canadian LPs exit Latin America, you have Longevity International completing a joint venture in Nicaragua for a large-scale processing facility and 2,200 acres of hemp grow. So it's not just LPs, but there's other multi-state operators like Planet 13 out of Las Vegas that have to renegotiate their license acquisition with Newtonian. So the deal between Planet 13 and Newtonian Principles had to renegotiate the terms of the previously canceled agreement. So the renegotiated deal included a 25% lease reduction. So this compares to the initial agreement where Planet 13 would have paid an additional $5.8 million in cash and over $2 million in Class A restricted shares. So Seeking Alpha's got a pretty good article looking at Canopy growth and their spending cuts and write-downs. It's not as bad as Aurora. They had a $1 billion write-down. But Canopy growth is a terrible story. So under Bruce Linton, their spending was out of control. And I've been saying this for months that I'm not a fan of Canopy growth. I don't even cover what Bruce Linton does in the psilocybin space because he's a PR campaign and that's it. He didn't do anything to generate revenue. This was all about public relations and press releases. So Canopy Growth spent $2.7 billion on acquisitions and burned another $2.6 billion in free cash flow since 2016. Most of these losses were incurred last year in 2019. So Canopy Growth's cuts are an admission of mistake, and they're long overdue. So you can see here that their revenue is kind of growing just a little bit, but not as fast as their free cash flow losses. So during 2019, the company burned through $1.5 billion of free cash flow with an even split amongst operating losses and capital expenditures to build out the Canadian cultivation facilities and other businesses. So since the beginning of 2016, they invested $2.6 billion in their business through free cash flow burn. So you can see that this graph had 2.7 billion that the company spent on acquisitions during the same time frame. This graph shows how Canopy grows significantly more cannabis than they sell, which is probably why they stopped growing in Latin America. You know what they say, never let a good crisis go to waste. So, well, the last time we reported, there's only 4 M&As. Now there's 17 starting to pick up. So it's going to be a lot more distressed assets as people look at existing infrastructures, like I mentioned, Washington and Oregon, some of these other spots like Nevada that are not doing well. And there's going to be some buyouts, whether that's appreciated or not. I think you're going to start to see a lot more consolidation, a lot more hostile takeovers where individuals go out and buy the outstanding shares and buy up all the company. So there's not going to be a whole lot of new startups. I think you're going to see a lot of companies struggle to gain capital in areas like Massachusetts or New Jersey or Florida, because you're going to see vultures come and look at existing property, plant, and equipment in existing states. So there's going to be pennies on the dollar here as companies and individuals try to get out right now. And so that's going to lead to a lot of fourth quarter pop in sales for those that do remain in business. I think it's just going to be a lot bigger conglomerates than we wanted. But this is going to be a huge shift, right? This is really where the industry decouples from corporate cannabis, and then eventually we'll get into more of a discerning segment. So as the LPs in Canada start shifting to outdoor cultivation, they're going to have the yields that they need to make the extracts and ingredients, giving mom and pops an opportunity to create more of that terpene, pungent, aromatic, flavorful, the preference that people want. You're going to go to that mom and pops. But you're going to have two types of customers, just like you have in every other product. So this segment in cannabis isn't going to be any different, but at least we're getting to that point where we can start to see that market start to form more professionally. But we're just going to have to wait and find out. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.